folks are suffering through this process and through this crisis. And I was out walking late last night around the streets and just watching the ambulances go by. I went by one of our local hospitals. I mean, these people are heroes, what they're doing, and the way they're treating people and being so responsive. So for corporations like ours that, frankly, are in good financial shape, it's an easy lift to support our employees in a time of stress like this. It's the least we can do, and I know a lot of other companies have done it. We're not unique at all, but we're a large company. We can absorb it, and we thought it was the right thing to do. And
did you get positive responses internally, or were people kind of, I guess, expecting it at all?
No, I think, listen, everybody's got so much to worry about. They're worried about their families. They're worried about their health. This was one worry we just wanted to take off the table for this year. And, yeah, of course, folks appreciate it. And our teams are doing a lot in their communities and a lot of other philanthropic stuff. But, it's what large companies should be doing. So I don't feel it was a particularly special moment. It was just something to help take one piece of anxiety off our employees and their families' shoulders.
And James, where are all of those employees at the moment? What percentage of the workforce is working at home? And have you been surprised by how the company's been able to continue its operations almost as normal, I guess, despite a lot working from home?
Yeah, it's extraordinary. We've got over 90% of our employees and contractors working from home, over 70,000 folks. That's all over the world, by the way, 90%. And the place is functioning. I mean, we had, for a period there, we had our 10 busiest days in history in terms of just volumes. Processed all of that well. We have BCP centers in London, Tokyo, Hong Kong, and, of course, New York, and that all functioned well. And, Wilfred, and you and I spoke about this a while back, if this had been during the financial crisis, which I also lived through, 12 years ago, the industry would not have been capable of handling this kind of response. We just didn't have the infrastructure set up, and I don't think Morgan Stanley is unique. I can't speak for the others, but I know based on my calls with the other CEOs, everybody's managed through this extraordinarily well.
Oh, well, it's good to hear that, James. And clearly volatility's back today, and it's been ferocious all year pretty much, but was particularly ferocious a couple of weeks ago. During those moments, I mean, gauge for us how bad was it? Were you worried about the outlook for the industry at all a couple of those trading days?
Well, listen, if you go back a couple of weeks, we obviously had the massive uncertainty around the health crisis, which we're getting more and more data on. It still remains very scary for a lot of people, but at least we have some understanding what the arc looks like, and there's some positive news coming out of particularly Korea and, what Hong Kong did and Singapore did. So there are examples where that works. But we had that going on with funding issues, massive liquidity issues, emerging credit issues, unemployment issues, and, of course, equity market volatility. So it's not surprising that 2 weeks ago was kind of the apex of collective anxiety. And, was I concerned? No, we're probably the largest. We are the largest equity volume transactor in the world. We have the largest equities business in the world. Our pipes were working, so I was confident the industry's pipes were working. But there were clearly liquidity challenges, which, and I'm sure we'll talk about the actions of the Fed and Treasury to deal with that, which they've done brilliantly.
Well, let's talk about that. I mean, how impressed have you been by their response, and what areas still need to be addressed? We've seen commercial paper and credit tick up again a little bit today. So talk us through the response and what you still need to see.
Yeah, well, just start with the human side. I mean, the most important initiatives separate the markets for the minute and just talk about unemployment and folks who are struggling. What Treasury did with the small business paycheck protection program, I think is just brilliant. You take out a loan as a small business owner, you hire your people back, and the loan gets forgiven. And, the infrastructure being set up with the banks and the lenders to process that. You combine that with the enhanced unemployment insurance. You combine that with what Freddie and Fannie are doing on the mortgage side. Potential, phase 4, further initiatives coming out of the government. I mean, it's been a bazooka of bazookas, and that has to give people some comfort. For the markets, what the Fed has done, and the way they've supported the CP market, they've supported the munis market. Obviously, they've figured out a whole range of things which we learnt from in the crisis, but the difference is the implementation has been dramatically accelerated here from sort of months down to days. And I think the Fed and the Fed markets folks in New York City, I'm on the New York Fed board, have done a brilliant job in navigating this, and that's why you're seeing liquidity come back. But, it remains choppy, and it's going to remain choppy for a while.
James, it's Sarah. Thanks for joining the show. Good to talk to you.
Sure, Sarah.
You just used the word apex when you were talking about the markets and sort of that period at the height of fear and some nervous sentiment. Does that mean you think we've seen the worst of it here?
Personally, I think we've seen the worst of the market funding liquidity issues. We've seen how the banks and market participants and the exchanges have operated, so we've seen a pretty good window into how the operations have held up globally. We're now all operating with 90% of our employees roughly from home. Probably all the banks are 80+%, so that's functioning. Equity markets, our house call is that we're banging around on, but honestly, the next 6 months still remain extremely uncertain, and despite the fiscal actions, you could see a lot of volatility, and we'll see in the equity markets. So, if I look at the aggregate of sort of market-related activities, I do think a couple of weeks ago felt to me like as bad as we were going to get without dramatically different economic or human tragedy taking place in the next several months.
So many of the Wall Street firms are saying we're already in recession. We've heard that. Even Jay Powell on the Today Show said that. And the forecasts are pretty bleak for at least the second quarter, down 20%, 35% for GDP. Is that something that you can see for this economy? And what would that mean for the banks?
Well, if you're having 3 million unemployment claims spike in a week, you're clearly in a recession. Whatever the technical moment of inflection point, we're going to have a global recession. I felt this a month ago, and that's clear. The issue is not do we have a recession? We are having a recession. The issue is how well do we rebound? Is it a V? Is it a U? Is it a long L? The bazooka efforts by the governments and the combined central banks would suggest that once the medical emergency passes and more people who have either been infected can go back to work, or the social distancing has worked where more and more people can be employed, I think the shorter the recessionary period. But we're going to have one. Whether the markets, whether the economy is down 20, 25, 30%, everybody's got an opinion on that for the next quarter. I'm less focused on. I'm more focused about long-term stability.
James, back to some Morgan Stanley specific questions, if we can. What are you thinking about the E-Trade acquisition? Do you think that was particularly well-timed when your stock price was higher, or badly timed relative, of course, to the environment that we're in now that you couldn't have predicted?
Well, I don't think it's fair to judge, and speak about valuation and so on. I think it was fairly valued. It was an all-stock deal, as you know. So, as both stocks have moved and would have moved post-crisis, I'm very comfortable with having done an all-stock deal. I'll just say that. As for the business, more importantly, the E-Trade folks, I think, have handled this brilliantly. They've had very little disruption in their platform, and this is exactly the kind of reasons why we want to buy this business. This gives us world-class technology capability, and particularly as people now have learnt to deal much more remotely, it will augment what we're doing with our financial advisors. So I think that's terrific, and it just provides more balance to our business model. It's more wealth management revenues, it's more stability, it's less volatile than the core markets businesses. So, net, I'm happier now that we did the deal when we did it. Would have been impossible to do it right now. The team over there is terrific. And, from the price perspective, it was a stock-for-stock deal, so it was pretty straightforward.
James, you're, of course, the current chair of the Financial Services Forum, and that was the medium that the suspension of buybacks for the big 8 banks was announced, so you were clearly front and center when that decision was unfolding. Where do you stand on dividend payments? Clearly, across Europe and the UK, that became very topical, and they all led to suspending their dividends. Will you and your peers keep your dividends, do you think?
Well, yes, we will. And let me just start with the buyback. This was a voluntary decision. It was pretty historic. the big banks got together and said, listen, we've got plenty of capital, but we want to preserve that capital to support our clients and our corporates and use our balance sheets to support them. And they came together as a group, and I thought that, I was really proud of the way that happened. And I know, the regulatory environment appreciated that, and it was a smart and wise thing to do. Dividends are a different matter. The banks have given up 70% of their capital distribution by foregoing buybacks. Remember, the recipient of the dividends are many times small individuals who own these very large bank stocks all over the country. To lose that income at this time, I happen to think would be a very poor thing to do. And, this is not about us as institutions. It's not going to materially change in terms of your capital picture by foregoing it, but I truly think it's destabilizing for investors, and it's dealing another punch in the head to the individual investor who, frankly, needs some of that dividend income coming in, whether it's from the banks or some of the other companies. Now, if we were capital short, that'd be completely different, but we're not. And I'm not going to comment on other regions of the world. I just focus on, the U.S. financial system for now.
James, I know we've got to let you go. Just a final kind of big picture question from me to finish things off on the banks. I mean, as we're talking, Morgan Stanley's down 8%, in line with all of the other banks. Your stock is down 40% year to date, and it was down more, of course, at the troughs of the market, which clearly paints a picture of at least a probability of Armageddon, even if that is the wrong picture it's painting. How should people think about what the banks are facing? Is it just an earnings hit for the year ahead, or is book value really under question to the extent that the share price has fallen, whether book value could halve as write-downs start to come out?
Yeah, listen, Wilfred, it's a fair question, and for better or for worse, as I said, I was co-president here during the financial crisis and took over the reins in early 2010, so I've kind of seen it all in the last 12 years. Our stock was $6.71. In 2012, I think it was $11. So when I'm looking at your screen now, $31.30, it feels actually pretty good for what we're dealing with. The market's scared. When the market's scared and volatile, you're going to, in the more volatile sectors like ours, like the energy sector, transportation, you're going to take these hits. But, 12 months ago, our stock was $40. 3 months ago, it was $58. Today, it's $31. And I'm going to say something that's probably going to surprise you. I really don't look at the stock at all now. I don't care. It's just not a meaningful driver of how our company is performing, what our book value is, what the quality of our operations are, and what we're doing to serve our clients. The stock will look after itself. That's the last of my issues.
Well, James, as always, we thank you so much for your time and your insight. Much appreciated.
Sure. Thanks, guys. Thanks, Sarah. Thanks, Wilfred.